Okay, Bismillahirrahmanirrahim. So the first one that we have looked into just now is target costing. Now let's look at computation of a target selling price using the cost plus pricing. So another method, the second one is cost plus pricing. So there are various methods on how to determine the price. The first one that we have looked into, the first method is the target costing. So the second one is cost plus pricing. So as the name implies, it means you look at the cost and then you plus a certain amount of profit, then you set the selling price. So in an environment with little or no competition, the company may have to set its own price. So previously we have looked into whereby there are a lot of competition. So when there are a lot of competition, you want to be competitive, then you have to look at your competitor's price. But in this case, there are certain scenario whereby there is very little or there is no competition. So you have to set your price. So when you want to set the price is normally a function of your cost, right? When you want to set the price, of course, you will depend on the cost that you have incurred. So that will be an approach to call as cost plus pricing. So approach requires establishing a cost base and adding a markup to determine a target selling price. So what is meant by markup? Markup is actually a percentage on your cost. And just to explain to you a little bit about what is the difference between markup and margin. Okay. Okay, markup is means a percentage on your cost, whereas if you use the word margin, that means it is the percentage on the selling price. So just take small figures. For example, your total cost is 8 and then your profit is 2. You've got your selling price of 10. So if the question says that markup, that means that is a percentage on cost. That is the profit percentage on cost actually. So that will be profit, that is 2 divided by your cost 8. So 2 divided by 8 times 100 gives you 25%. So what is the markup? The markup is 25%. If the question asks you to calculate the margin, margin means the profit margin. So profit margin means profit on the sales or percentage on the selling price. So that will be profit of 2 divided by the selling price of 10. Then you express it in terms of percentage. That means 2 over 10 times 100 gives you 20%. So based on this, if we say how much is the markup, so markup is 25%. That means the 2 over your 2, that is your profit over your cost. If it is a margin, that will be 2 over your selling price, so 20%. Okay, so that is the difference between markup and margin. Okay, back to this one. If you want to the approach of cost plus pricing, that means you take the cost. So approach requires establishing a cost base and adding a markup to determine a target selling price. So you determine how much is your cost and then you add a markup. If let's say just now in our example, your cost is 8 and then you add a markup of 25%, then you've got your target selling price of 10. Okay. So that is how you determine the cost plus pricing. Okay, in determining the proper markup, a company must consider competitive and market conditions. So size of the markup, that means the plus that you, the markup, how much do you want, the extra that you want, the plus that you want. So depends on the desired return on investment for the product. So how much is the markup that you want just now? This one. The markup that you want normally depends on the return on investment, the desired ROI in short. Okay, so you look at the ROI. ROI is basically the net income divided by the invested capital or invested asset. Okay, return on investment. So you invest, then you want to have a return. So that is basically what is meant by return on investment. So selling price minus your cost will give you a markup or the profit. So this is just the reverse of this one. So that means selling price minus your markup will give your cost. Markup means the desired profit here just now. Okay. So selling price minus cost gives you your profit. Okay. You can look at this example. Okay. Thinkmore Products Incorporation is in the process of setting a selling price, okay, on its new video camera pen. So it is a functioning pen that will record up to 2 hours of audio and video. So the per unit variable cost estimates for the new video camera pen are as follows. So you are producing a video camera pen, and then you are being given the information, the per unit. So that means the direct material, the direct labor, variable manufacturing overhead, variable selling and admin expense. You have the variable cost per unit. The total of this gives you 60 ringgit. In addition, Thinkmore has the following fixed cost per unit at a budgeted sales volume of 10,000 units. So this one, you have the fixed cost per unit. Okay, you fix manufacturing overhead of 350,000, and then fixed selling and admin expense of 300,000. So this information is given, and then this information is calculated based on a budgeted sales volume, based on a budgeted sales volume of 10,000 units. So if you were to work out per unit, then you divide by the budgeted volume. So you will get fixed manufacturing overhead per unit as 35 and fixed selling and admin as 30. So your fixed cost per unit is 65. So Thinkmore has decided to price its new video camera pen to earn a 20% return on investment of 2 million. So your markup equals to 20% ROI of 2 million. So your expected ROI will be per unit will be 40. So variable cost per unit of 60, and then you have worked out just now your fixed cost per unit at 65. So your total cost is 125. And then your desired ROI per unit or your markup just now, you have worked out. Your markup is 40 here. Your markup per unit is 40. So your selling price will be your total cost plus your markup gives you 165. Okay, this one, if let's say the question asks you to compute the markup percentage, okay, use markup on cost to set a selling price, compute the markup percentage to achieve a desired ROI of 20 ringgit per unit. So your markup just now is 40 divided by your cost per unit, that is 125. So your markup is 40 divided by 125, so that gives you a 32%. Remember the one that I've shown you before, if you want to calculate markup is percentage on cost. So your profit, that is your undesired ROI just now, 40 divided by 125. So you will get 32. If the question asks you to compute the target selling price, so that will be the total cost plus the this one, total unit cost times the markup percentage, then you will get a target selling price of 165. Okay, this one is how you work it out. Okay, there are also limitations of cost plus pricing. The advantage of cost plus pricing is that it is easy to compute. Okay, the disadvantage, it does not consider the demand side. Will the customer pay the price? So if you are using the cost plus pricing, it's like the traditional approach that I've explained earlier. That means you look at your cost only, then only you add the desired profit that you want, and then you set the selling price. But what about the customers? Are the customers willing to pay at 165 ringgit just now? So you do not consider the demand side of the product. So that is the limitation of cost plus pricing. And then fixed cost per unit changes with the changes in sales volume. So at lower sales volume, company must charge higher price to meet the desired ROI, because you remember the fixed cost, how does the fixed cost behave? So the greater that you produce, the greater quantity that you produce, then the fixed cost per unit will be spread over a larger amount, a larger quantity. So the per unit will be reduced. So at lower sales volume, company must charge higher price because you want to cover your fixed cost. Okay. So this one, you can look here, limitations of cost plus pricing. So if budgeted sales volume of Thinkmore's product was 5,000 instead of 10,000, remember previously we produced 10,000 units. But what if you produce a lower amount? So if you produce a lower amount, let's say you produce 5,000 instead of 10,000. So the cost will be spread with a lower, a less quantity. That means less, the piece of cake, that means the fixed cost now being shared only by the 5,000 units instead of by the 10,000 units. So each unit will carry a greater portion of your fixed cost. So Thinkmore's variable cost per unit would remain the same. However, the fixed cost per unit, we are talking about the per unit, would change as follows. So now the total fixed cost remains the same. Okay, the total remains the same, but now you spread the cost with a less amount of units. So per unit, you will have 130 instead of previously you have, so you have 65. Remember previously the same amount of the cost, but you divide by the 10,000. If you divide by 10,000, per unit will be 35 and 30. So the total per unit will be 65 only. Okay. But now you divide by only 5,000. So the per unit will be 130. So Thinkmore's desired 20% ROI now results in a 80 ringgit ROI per unit. Okay, so this one, because you divide, you have the, each unit will carry a greater portion of your fixed cost. Okay, so Thinkmore computes the selling price at 5,000 units as follows. So your variable cost 60, your fixed cost now, instead of 65, your fixed cost now becomes 130. So your total cost now becomes 190. So your markup or your desired ROI per unit is 80 and your selling price is 270. So at 5,000 units, how much would Thinkmore markup its total unit cost to earn a desired ROI of 80 ringgit per unit? So that will be, okay, 80 divided by 190. So your markup is 2.11%, right? So alternative pricing approach, okay, this one is simply add a markup to variable cost. This one avoids the problem of uncertain cost information related to fixed cost per unit computation, and it is helpful in pricing special orders or when you have excess capacity. The major disadvantage is that the managers may set the price too low and fail to cover your fixed cost. Okay, this one is just, you simply add a markup to your variable cost. You have a certain amount of variable cost. Let's say your variable cost is 80, then you just add a certain amount of markup, whatever percentage that you want. But this one, yes, it is easy to use, helpful in pricing special order when you have the excess capacity. But the major disadvantage is that maybe you fail to cover your fixed cost. Okay, so cost plus pricing means that, so selling price equals to variable cost plus markup percentage plus variable cost, or which one is the answer? So that would be selling price equals to your cost plus the markup percentage times with your cost. So that's how you do the cost plus pricing. So hopefully you have a better understanding on cost plus pricing. Okay, with that, I thank you.